Right now, American traders are adopting a wait-and-watch approach. When global data looks uncertain, U.S. investors typically shift toward safer sectors, reduce unnecessary risk, and pay close attention to upcoming economic announcements. This week, the market is preparing for important updates from the Federal Reserve, along with new inflation and labor market data. These events have the potential to move the market sharply in either direction. So overall, the market is not showing a clear, bullish or bearish direction. Instead, it is holding steady in a neutral zone, waiting for stronger signals. Traders understand that any major announcement, either positive or negative, can push sentiment quickly. For now, the market mood is calm, cautious, and focused on clarity that has yet to arrive. The second major force shaping the U.S. market right now is investor anticipation around the Federal Reserve's next move. Wall Street is extremely sensitive to even the smallest hints from the Fed, because interest rates remain the single strongest driver of stock valuations. When rates are high, borrowing becomes expensive, corporate profits tighten, and growth stocks, especially tech, tend to struggle. On the other hand, any signal that the Fed might slow down, pause, or cut rates immediately injects optimism into the market. That's why traders are carefully analyzing every speech, report, and comment coming from U.S. central bankers. Investors know that the Fed is walking a tightrope. If inflation rises again, the central bank may be forced to stay aggressive. But if inflation cools and economic data weakens, the Fed could shift towards supporting growth. This uncertainty creates a highly reactive environment where even a single paragraph from a Fed statement can move billions of dollars within minutes. Traders want clarity, but the Fed is intentionally cautious with its wording, which means the market keeps swinging between hope and hesitation. Right now, the dominant mindset is, don't guess, wait for confirmation. Large institutions are avoiding overly risky bets until they see a clearer direction from the Fed. Meanwhile, retail investors are confused because the market sends mixed signals: one day bullish, the next day defensive. This is a classic pre-announcement phase, where the entire market breathes slowly, stays alert, and waits for the next big clue from America's central bank. Global market rotation is a crucial signal that U.S. investors cannot ignore. Over the past week, European markets, particularly the FTSE 100, have seen a noticeable shift in sector performance. Energy stocks have been declining, banks are under pressure, and defensive sectors, like consumer staples, healthcare, and luxury goods are gaining attention. Asia, especially China, is showing softer industrial activity, which adds to the caution in global sentiment. These rotations indicate that investors are moving money from high-risk, high-volatility sectors into more stable and predictable assets, signaling potential stress or hesitation in the broader economy. For us traders, this rotation has important implications. It suggests that even if the S&P 500 or Nasdaq appear near record highs, market momentum may be slowing. Investors are watching which sectors are accumulating capital and which are being sold off, because these patterns often precede U.S. sector rotations. For instance, tech stocks might pause or consolidate, while defensive stocks like healthcare and utilities could see inflow. Large-cap consumer brands may benefit as global investors seek stable cash flows. Essentially, the signal is clear. The market is rotating from riskier to safer areas, preparing for uncertainty while waiting for economic clarity. In summary, understanding global sector rotation helps U.S. investors anticipate potential opportunities and risks. Markets are sending signals about investor behavior worldwide, and following these trends can guide tactical positioning even before domestic economic announcements occur. The energy sector is sending one of the clearest market signals this week. Oil prices have been declining, causing major energy companies like BP and Shell to see significant drops in their stock prices. This weakness is not just a European phenomenon. It carries global implications that directly affect us energy majors such as ExxonMobil and Chevron. Falling oil prices can reduce profits for energy companies, pressure dividend yields, and create short-term volatility in related sectors, including industrials and transport. For investors, this is a signal to watch carefully. The market is indicating potential caution in energy, but it can also present opportunities for those looking for long-term value and high-quality energy stocks. For us traders, the implications are twofold. First, short-term weakness may influence market sentiment, dragging down energy-heavy indices and increasing overall volatility. Second, dividend-focused or value-oriented investors may view this as a buying opportunity, as historically, energy stocks often recover after short-term price drops if global demand stabilizes. Additionally, energy's performance can act as a signal for broader economic health. When oil declines, it sometimes reflects weaker industrial activity or slower global growth, prompting defensive positioning in other sectors. Overall, the energy sector is both a risk indicator and a potential opportunity. Traders are advised to watch for signals from crude inventories, production reports, and geopolitical developments, as these factors will determine whether weakness persists or a rebound occurs. Index reshuffles and legal overhangs are subtle but powerful signals for investors. In the UK, British land is being promoted to the FTSE 100. WHILEWPP is being relegated to the FTSE 250. Such changes may seem technical, but they often trigger significant buying or selling by institutional investors who track index memberships. For us traders, this is an important reminder. Even overseas index adjustments can influence global equity flows and sector sentiment. Stocks experiencing a promotion may see short-term price gains, while those being removed can experience temporary pressure due to forced sales. Legal overhangs further complicate the picture. WPP, for example, faces class action deadlines, creating uncertainty around potential future liabilities. U.S. investors should watch similar situations domestically. Legal risks can suppress stock performance, even when fundamentals remain strong. The combination of index reshuffles and legal factors sends a clear market signal. Pay attention to structural flows and regulatory legal news, because they can amplify short-term volatility. Traders and investors often react to these events ahead of the official changes, providing opportunities for those who anticipate the movements correctly. Overall, this scene underscores that beyond macroeconomic trends, market mechanics such as index changes and legal risks create actionable signals. Understanding these flows helps investors position themselves strategically for both short-term trading and medium-term portfolio adjustments.